Hi and welcome to Swissquote's Daily Market Talk. It's Friday, June 27th. Geopolitical tensions disappear from the headlines and are being gently replaced by trade news, with the big news of today being a trade agreement between the US and China. The latter also counters the unideal flow of growth and consumer data, hinting that the market rally that we have today could eventually extend against all odds. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the month of June is approaching its end, with US equities having rebounded back to their all-time high levels, having fully brushed off the trade war-led sell-off between February and April of this year. Now, funny enough, the rally that we saw over the past few weeks and months was not necessarily backed by a material progress in trade negotiations between the US and partners, but rather by the so-called TECO trade and the FOMO trade. So TECO standing for Trump always chickens out, and FOMO, as you know, stands for fear of missing out, probably the chickening out rally. So there is also in the market among investors a conviction that the Fed will cut the interest rate sooner rather than later, that the earnings for the S&P 500 companies and the earnings growth will remain strong despite the trade uncertainties, and that the AI will probably bring some, notable productivity and notably lower costs on the table moving forward. But the Fed members keep telling investors that they are not planning to cut the interest rates before fall. Many companies out there actually refrained from giving earnings guidance last quarter, remember, because trade uncertainties are just too big to make a reasonable forecast, and the AI productivity is certainly months, if not years away. So the equity rally looks stretched at the current levels. Happily though, stretch doesn't mean it will not continue. If investors are fed rapid sugar, we could see asset prices continue to inflate indeed, and Donald Trump may eventually feed the market and feed investors what they want, because the US and China apparently reached a trade truce. And the Trump administration said that 10 more deals could be imminent. And the EU's von der Leyen said that she's ready to talk when the US is ready, in an effort to reach an agreement before the July deadline. And the US bank investors are enjoying the news of the week of softer regulation on leverage rules that should allow them to free up to $6 trillion in additional balance sheet facility. As such, the futures are in the positive this morning. But overall, the tariff uncertainties will continue to persist for key sectors like metals, cars, and technology. The direction and the speed of the US debt hasn't changed at all. On the contrary, the way that the things are developing right now actually hints that Donald Trump's administration's spending cuts will be eaten and more by the rising benefits to enriching the already rich Americans, and the geopolitical situation in the Middle East remains tense and highly uncertain, with Iran now claiming that the US bombing of last weekend didn't do much harm to their nuclear facilities, a claim that's also being backed by the European officials, mind you. So all of these factors are not necessarily positive for risk appetite. And on the data front, the news is not brilliant either, mind you. Yesterday's GDP update from the US showed that the US economy, it's slow more than previously printed in the first quarter of this year. While the slowing exports and the pre-tariff spike in imports explain a part of the slowdown in the US economy, a sharp decline in sales numbers of more than 3% also explains a part of it, and the latter is also backed by sentiment surveys of these days, with Michigan's sentiment index falling nearly 30% this spring and staying stuck near the post-pandemic low levels, and that's obviously due to the tariff uncertainties. So Bloomberg actually highlights that over the 79 years of the survey, a drop this large has almost always predicted a recession. On the jobs front, the latest jobs data actually in the US continue to show surprise resilience, but the continuing jobless claims are rising quite notably these days and hinting that something could be preparing. And on the inflation front, the price pressures in the US were surprisingly contained so far, but inflation risks remain tilted toward the upside with potential tariffs. So today we will be focusing on the US core PCE data, which is the Fed's favorite gauge of inflation, which could actually show a slight quickening in the inflation metrics in the US that should maybe further cement the idea that the Fed should wait before cutting the interest rates, but I'm not really sure that the investors are willing to hear any of that. So all that looks like peanuts to retail investors, I said, that are believed to be shouldering the rally right now by ignoring the rising risks on the fundamental side. So in the best case scenario, the trade deals between the US and partners will come through, and the institutional investors who have been on the sidelines will join the retail crowd, and the global equities will be on track for further highs. Or the other scenario is that the summer will be hot in the markets, and the inability to reach trade deals between the US and the major trading partners will dent sentiment and trigger a downside correction. Pick your side. The fun fact is that the Chinese CSI 300 index is barely reacting to the trade truce news with the US this morning. That's perhaps on news that the industrial profits in China actually dropped by more than 1% in the period from January to May, reversing an early 1.4% advance. In the FX markets, the US dollar index fell to a fresh 3-year low yesterday, partly driven lower by the news that Donald Trump will nominate the next Fed head as soon as next fall in an effort to soften Jerome Powell's cautiously hawkish stance and potentially dent the Fed's credibility at a very critical time when investors around the world are losing faith in the US dollar and in the US debt. As such, the euro dollar just went above the 117 mark this week, but consolidates gains a touch below this level this morning. Any good news on the trade front could eventually reverse a part of the gains by unwinding some of the trade-led losses in the US dollar and prevent the pair from reaching the 120 psychological mark before this fall. And same story is unfolding with cable. Cable is consolidating gains near the 137 level this morning, but a series of trade deals could actually reverse a part of the year-to-date gains if the US dollar appreciates on trade deals. Gold, on the other hand, just slipped below its 50-day moving average and could return as low as $3,000 per ounce level with improved trade setup, while crude oil tested but held ground above the critical $65 per barrel support, which is the major 38.2% Fibonacci retracement on the year-to-date decline, and which actually distinguishes between the year-to-date negative trend in oil prices and a nascent bullish breakout, mostly due to the geopolitical tensions of late. Now, positive trade news could help improve the global demand prospects and hence throw a fundamentally supported floor under the price of a barrel near the $65 per barrel mark. But as you understood well, the headlines will be shifting from the geopolitics toward the trade negotiations in the coming days. And if the news are satisfactory, the risk rally that we've been seeing since a few weeks now could simply grow stronger. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.